Introduction to financial statements. Financial statements are the primary tools through which businesses communicate their financial performance and condition. Financial statements are the lifeblood of business decision-making. These formal records provide insights into an organization's financial activities, helping managers, investors, creditors, and regulatory agencies assess performance and make informed decisions. Understanding these statements is essential for internal financial control and for communicating financial outcomes externally. There are 4 core financial statements every finance professional must master: income statement, profit and loss statement, balance sheet, statement of financial position, cash flow, statement of changes in balance sheet. Income statement, profit and loss statement, reflects the company's revenues, expenses, and net income over a period of time. Balance sheet, statement of financial position, presents a snapshot of the company's assets, liabilities, and equity at a specific point in time. Cash flow statement tracks the inflows and outflows of cash, categorized into operations, investing, and financing activities. Statement of changes in equity shows movements in owner's equity over time, including retained earnings, issuance of shares, and dividends. These statements are interconnected. For instance, net profit from the income statement is reflected in the equity section of the balance sheet and used in calculating cash flows from operations. Learning outcomes. Upon successful completion, you will be able to comprehensively interpret financial statements and perform deep financial analyses, understand and apply the time value of money in investment appraisals, differentiate between various types and sources of finance, and determine their implications, make strategic capital budgeting decisions using advanced financial tools, manage working capital efficiently to optimize business liquidity and operational efficiency. Evaluate and mitigate financial risks through analytical and practical approaches. Develop and analyze financial plans and budgets. Understand and assess corporate financial strategies, including mergers, acquisitions, and leverage. The income statement. Measuring profitability. The income statement is fundamental to assessing profitability. It breaks down revenues and subtracts the costs and expenses incurred to generate those revenues, arriving at the net profit or loss. Key components: revenue/sales, total amount earned from selling goods or services, COGS, cost of goods sold, direct costs attributable to production, gross profit, revenue minus COGS, operating expenses, administrative, marketing, and selling costs, EBIT, earnings before interest and taxes, operating profit after deducting expenses, net profit, final profit after interest and taxes. Significance. The income statement helps stakeholders track profitability trends, operational efficiency, and cost management strategies. By comparing income statements across periods, businesses can assess growth or contraction. Practical example. A fashion retailer records 25 million naira in sales, 10 million naira in COGS, and 8 million naira in operating expenses, with a 2 million naira tax bill. Net profit equals 5 million naira. The balance sheet. Assessing financial position. The balance sheet is a detailed statement showing the financial position of an enterprise. It lists what the company owns, assets, what it owes, liabilities, and the residual interest, equity. Structure, assets, current, cash, accounts receivable, inventory. Non-current, property, machinery, long-term investments, liabilities, current. Accounts payable, wages payable, short-term debt, non-current, bonds payable, bank loans, equity contributed capital, retained earnings. Core equation, assets equals liabilities plus equity. This formula ensures that the balance sheet always remains in balance. It also indicates the leverage level of the business and how much of the assets are funded by owners versus creditors. Strategic value. Lenders assess creditworthiness. Investors evaluate capital structure. Managers analyze working capital sufficiency. Case insight. A real estate firm with high fixed assets and low current assets may need liquidity planning to avoid cash crunches. The cash flow statement, liquidity monitoring. Unlike the income statement, which may reflect accrued revenues and expenses, the cash flow statement focuses on actual cash transactions. 3 segments. Operating activities. Core business income and payments, e.g., customer receipts, salary payments. Investing activities. Purchase/sale of long-term assets, like land, equipment, or securities. Financing activities. Inflows from loans or equity issuance. Outflows for repayments or dividends. Importance. Reveals actual cash generated by operations. Highlights sustainability and solvency. Aids in budgeting and forecasting. Example: A company might show 10 million naira net profit, but only 1 million naira in operating cash flow due to large accounts receivable and inventory buildup. 2.5 Statement of changes in equity. This often overlooked statement plays a critical role in tracking changes in ownership equity. Key entries. Net profit from OPE dividends issued to shareholders, the cash flow statement, liquidity monitoring. Unlike the income statement, which may reflect accrued revenues and expenses, the cash flow statement focuses on actual cash transactions. 3 segments. Operating activities. Core business income and payments, e.g., customer receipts, salary payments. Investing activities. Purchase/sale of long-term assets, like land, equipment, or securities. Financing activities. Inflows from loans or equity issuance. Outflows for repayments or dividends. Importance. Reveals actual cash generated by operations. Highlights sustainability and solvency. Aids in budgeting and forecasting. Example: A company might show 10 million naira net profit, but only 1 million naira in operating cash flow due to large accounts receivable and inventory buildup. 2.5 Statement of changes in equity. This often overlooked statement plays a critical role in tracking changes in ownership equity. Key entries. Net profit from operations. Dividends issued to shareholders / average inventory. Receivables. Turnover equals revenue divided by average accounts. Receivable application. These ratios allow management to set benchmarks, detect inefficiencies, and guide future strategy. For external users, they're indispensable for credit analysis, investment decisions, and valuations. Horizontal and vertical analysis. These techniques help to identify trends and proportions. Horizontal analysis compares specific items over multiple periods, e.g., comparing net income from 2023 and 2024. This reveals growth trends, volatility, and consistency. Vertical analysis. Expresses each item in a financial statement as a percentage of a base item. For instance, in an income statement, all items might be expressed as a % of revenue. Benefits. Enhances comparability across periods or entities, pinpoints cost drivers or growth inhibitors. Common size statements and benchmarking. Common size statements, period. These convert financial statements into percentages. For instance, a common size income statement displays each line as a % of total revenue, while a balance sheet might use total assets. Benchmarking. Compares company performance against competitors or industry averages. identifies gaps and opportunities for improvement. Best practice: use a combination of benchmarking and common size analysis to support strategic decision-making and financial re-engineering. Real-world application and decision-making: how businesses use financial statements. Lenders examine balance sheets and cash flow to determine loan terms. Investors analyze profitability and risk using ratios and trends. Management makes cost-cutting or investment decisions based on income trends and asset efficiency. Governments and tax authorities review financial statements for compliance and taxation. Example: a Nigerian agricultural startup uses vertical analysis to identify that 40% of revenue is spent on distribution logistics. It negotiates new transport contracts and reduces this to 25%, boosting net margins by 8%. 2.10. Summary and review. Financial statements are the foundation of sound financial decision-making. Together, the income statement, balance sheet, cash flow statement, and equity statement provide a comprehensive picture of an organization's health. Proper analysis using ratios, horizontal and vertical tools, and benchmarking transforms raw data into actionable intelligence. Let me know when you're ready to continue to Module 3 or want an illustrated summary for Module 2. Here are 5 multiple-choice quiz questions based on Module 2. Financial statements and analysis, along with their correct answers.